Alright everyone, Cowboy Trades here, welcome back to the channel for a quick update on the stock market. So, there's some worrying signals playing out in the lower time frames, and in the higher time frames we've once again got our recession signals flashing. So let's dive into this. Let's start off on the lower time frames and build our way up, starting off with the 4-hour chart for the SP 500. Now, I briefly just touched on this in a Bitcoin video I recorded. For Bitcoin, we do have something like a W pattern playing out. However, on the SP 500, you can see that it looked like we were pushing up to make a W pattern. We didn't make it up to the neckline, and we've started to turn down. And in the past few hours or so, we've got a harsh rejection candle. If we come over to the 1-hour time frame, you can see we were grinding up for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 hours, and then within 3 hours we've just wiped out pretty much 90% of those gains. So the S&P 500 is looking pretty bearish right now. It's not only the fact that we've just wiped out a few gains, it's the fact that we keep on making lower highs after retesting these crucial trend lines. If we come over to the daily, we talked about this many times on the channel, but we've just broken to the downside of this asymmetrical triangle. So things are looking pretty nasty, and I'll also touch on another rejection point in the higher time frames in just 1 second. Now, for the past few days as well, we've got Fed futures on the up and up. The last time we talked about these, we talked about how the markets were expecting Fed futures to rise from where they are right now at 4.75% all the way up to 5.3%, and they're currently now clocking in at 5.335%. which is a whole 58.5% basis increase from where the interest rates are currently residing. So the markets are definitely starting to price in a more hawkish Fed as inflation expectations have exceeded consensus. And now, with the upcoming FOMC meeting right around the corner, we've got 50 basis points on the table. It's looking like Fed futures are going to continue to rise into this event, and the markets are probably going to continue to break down. Now, if we come over to some slightly higher time frame charts before we head over to the macro, government bonds. Let's start off on the 10 years. Now, yesterday we talked about how the US government bond 10 years pushed up to the highest level since all the way back here, the 10th of November 2022. So the 10-year government bonds is absolutely skyrocketing right now. And if we come over to the 2-year bonds, today, these just pushed up to a new high. Let me just double check. You can see we've just exceeded this high from over here. So if we come over to the weekly time frame, you can actually see that once again, the government bonds for the 2-year yields are the highest they've been since the 31st of October 2022. If you're new to the channel and you don't know how these correlate to the S&P 500 or your cryptocurrency markets, really they're just inversely correlated. The more profitable holding, low risk government bonds becomes. So right now you can lock in at a 2-year rate 4.85% APY. Then of course you're not going to want to invest in the S&P 500, which is far more risk on at this moment in time, which is why you see this clear inverse correlation between government bonds and your equity markets and also your cryptocurrency markets. So while we're really waiting for this S&P 500 breakdown to finally start clocking in, we've got Fed futures rising, we've got government bonds rising to the highest levels year to date. And because of this, especially in the fact that the 2-year bonds have been absolutely rocketing a little bit faster than the 10-year bonds. Not necessarily today, but you can definitely see over on the 10-year here, we're quite far away from making new highs, but the 2-year government bonds are literally getting ready to push up to new all-time highs very soon. So this is why when we come over to the yield curve, when we look at the summation of the US 10-year bonds minus the valuation of the 2-year bonds, we're seeing that the yield curve is once again becoming even more inverted. Now, I've made an educational series video before about understanding the yield curve in this video here titled Understanding Market Conditions. But if you want a brief run over of how the yield curve affects the markets, I've made a quick summary over here. Historically, protracted inversions of the yield curve have preceded recessions in the United States. An inverted curve reflects bond market investors' expectations for a decline in longer term interest rates as a result of a deteriorating economic performance. So this is why, on the daily time frame, I just want to show you over here today, we have broken down into new lows for the yield curve. And as we've previously discussed on the channel, If we zoom out, this is where you can really see how important the yield curve is. And you can really understand this brief synopsis of how important the yield curve is over here. So like we discussed, when the yield curve becomes heavily inverted, this is when bond market investors start pricing in recessions. And they priced in the recession in the Gulf War before it fully happened. They priced in the 2000 dot-com crisis just before it happened. You can see, obviously, the 2008 financial crisis, as we all know it, was being priced in by bond market investors back here in the yield curve in February 2006. And coming into 2007, you can see we came out of this inverted yield curve, meaning that bond market investors were saying the markets are super overextended, something is wrong, we're very likely to head into recession, and they were ahead of their time on this call. Now once again, you can see, the lowest we went to was all the way back in 1989, just before the Gulf War. There was a pretty big recession in terms of GDP back here, not necessarily in terms of the stock market's performance. However, coming into 2023, you can see this red box that we've got, which has marked previous lows for the yield curve, has just been violated, and we've completely capitulated to the downside of this. And since our last update on this, we made a video on this the other day. If I come over to my channel, it was right over here. The first time since 2008 where we made an in-depth video about the yield curve. We've once again broken down into new lows for this. Now there's a few other things that I do just really quickly want to touch on before we do wrap up the video. I can actually see in the lower time frames, we are getting more and more continuation as I am recording this video as the SP 500 drops. But coming over to the VIX is up a little bit today, bouncing from this historic support, getting a little bit of continuation. But what I really want to show you is the fact that we are really gearing up for this huge volatile market event. The VIX has been pricing in forward volatility in this market since all the way back here in 2017, where you can see we had a low for the VIX, and since then we've been grinding up on this trend line, meaning that investors have been pricing in more volatility in these markets for a whole 6 years or so. So why is this bad? We've talked about this before on the channel. When you're in a bull market, or more specifically when you're in a healthy bull market, because you're in a healthy bull market, traders start to price in less forward volatility. So you can see over here, lower lows for the VIX, and you have a healthy bull run. But then something changes right around here. When this low came in for the VIX, what happened is traders said, hey, the markets are super overextended. And once again, just like when we come over to the yield curve on the monthly time frame, come back over to what happened in 2006, 2007, the bond market investors were pricing in this recession because of the inverted yield curve. And when you come over to the VIX, the volatility traders were pricing in tons of forward volatility from this moment in time. And they were saying, even if we get a little bit more continuation in the SP 500 before we break down, this is now an unhealthy bull market, as there's lots of forward volatility to price into the markets. And you can see, once we bounce from this key trend line, that final blow off top for the VIX happened. And this is really where your equity markets and Bitcoin wasn't around here, but you could imagine cryptocurrency markets probably would have nuked at this moment in time as well. We obviously can't talk about that. Bitcoin was not trading in the 2008 financial crisis, but forward volatility back here in the VIX was literally marking a huge move down for the equity markets, a huge move up in terms of volatility, and also a huge inversion of the yield curve, which, as we've discussed, is a precursor to recessions in the market. So we're still seeing the VIX bouncing from this key trend line at this moment in time, and the more and more we bounce on this trend line and grind up and get more forward volatility, the more the markets are going to have an absolute melt when they are getting ready for it. And in the higher time frames, really, there is another trend line that you really do need to keep your eyes on. As we discussed in this chart over here, we have broken down from this asymmetrical triangle, but if we zoom out even further on the weekly time frame, you can see that we've lost this key downtrending line of resistance. We had a throw over from this recently, And with these blue lines on my screen right here, you can see this correlates to when corporate insiders start to sell. At this moment in time, I've just recorded a Bitcoin video about how Bitcoin whales and smart money are selling, but you can also see these spikes that have happened in the market correlate to insiders starting to sell. We made a dedicated video to this 13 days ago over on the channel. Insiders are selling their stocks, and you can see the S&P 500 has really started to move down from this moment in time. So once again, insiders literally perfectly timed the top in this market, and since insiders have sold, we completed this throw over from this trend line, and we've broken back down to the downside on the daily. You can see we've been getting our head bashed against this trend line, and it looks like we're starting to get that continuation. So there we go. Just wanted to give you an update on everything that's happening in the equity markets right now. Really, you know, the markets are starting to price in more interest rate hikes. We're getting rejected from these crucial levels for the S&P 500. Lower time frames, we've got bearish engulfing patterns. Traders are still pricing in huge volatility to come in. The yield curve is more inverted than it's been in history, and with this, government bonds are pushing up to new levels, which should be a telltale sign that the equity markets are about to have an absolute nuke to the downside. So for today, my friends, that's all I've got. As always, if you do enjoy my stock market content, let me know down below by leaving a like and a comment. Share the videos with your friends. Also, be sure to come and follow me over on Twitter at 618_cowboy. But for today, that's all I've got. It's been your boy Cowboy Trades. I'm out. Peace.